and welcome everybody. As you all know, we're going to review equity factor performance in 2022. It was a very exciting year for equity factor performance. But we're going to not only review the actual numbers, but we're also going to look at some attribution and analyze performance from the standpoints of sectors, macro factors, and social distancing and intangible characteristics, which were also have been hot topics over the last few years. So before we begin with our review, I think it's important to review scientific beta's approach to factor investing. Now, from our standpoint, for many years, our view has been that it makes the most sense to invest in a limited set of what we call economically rewarded factors, right? So these are factors that are intuitive from an economic or financial standpoint. They're not complex, synthetic, or purely statistical factors. On the one hand, they're understandable. On the other hand, they have been vetted over the years by not only researchers at Scientific Beta, but also other academics. And we believe that this consensus, where different groups of investors and researchers are coming to the same conclusion with regards to which factors are actually investable and make sense from an economic standpoint, is the best way to construct factor portfolios, right? So, we see in the finance literature often factors that have been generated synthetically or based on one sample of data. And we regard those results as not as reliable as those that have been produced by different research groups using data that spans very long term, using different subsamples, regimes, et cetera, which we feel results in a more robust product at the end of the day. Now, the second pillar of our factor investing approach is that we recognize that macro factors in the business cycle can have impact, short-term impact on factor performance. But if you look at the long term, that's not necessarily the case. So aside from these short-term fluctuations that may have some impact on factor performance, in general, the impact of macro factors in the business cycle is somewhat muted over the longer term on factor performance. Now, 2022 was somewhat of a different year, which we'll discuss in a second, but it's important to keep that in mind that, our primary focus and portfolio, our investment process is structured around a limited set of economically relevant factors, equity factors, not so much the macro factors, which long-term play a somewhat marginal role. But we'll see the story was a little bit different here. Now we're going to go through U.S. performance, but also we're going to touch on developed ex-U.S. And without further ado, let's jump right into it. So as we see on the first slide, we can make a few observations initially. One is that almost all factors had positive performance. Now, when you look at the performance here, let's be clear about what we're talking about. We're talking about factor portfolios, long-short portfolios. So we're taking a universe of stocks. We're going along those stocks that have the highest or most, the most exposure, the highest sensitivity to a given factor, and we're shorting the ones that have the least sensitivity. And the result of that is a long-short factor portfolio. So the returns that we're looking at here are the performance measurement with regards to those portfolios. Okay. Now, we can see here that cross-sectionally, we look at all the factors except for high profitability. We've had positive performance in 2022, and the average return, which is 6.9% on the far right in the last column, is higher than their long-term average, over 45 years, so over a very long time span. Now, we can note that momentum, low investment, and value had strong performances over their long-term average, but they were still below their 5% best annual rolling returns. Okay, so good results, but not historically good. Let's put it that way. For low volatility in size, we can say that they had positive performance, but below their long-term average. Now, that one outlier here is high profitability, because not only were the returns negative, but they were actually below the 5% annual rolling returns. So it's sort of a negative outlier here. Now, before we go to the next slide, I want to make 2 points here. One is that these results contradict some popular narratives that we saw in the financial media last year and have continued into this year. One is that the return of factors, if you will, was really mainly a value story. And we see here that that's not necessarily the case, because across the broad cross section of factors, except for high profitability, we see that there actually was positive performance and quite strong performance across the set. The second sort of highlight here, or interesting find, if you will, is that one of the things we heard last year was, okay, it's a macro regime shift. Interest rates are rising. So now what you have to do is sell all the unprofitable stocks and buy all the profitable stocks. And that's all you need to do. Well, lo and behold, we see on this slide that's not necessarily the case. Because if you just took that approach where you said, look, let's just buy a basket of highly profitable stocks, the results would not have been what you may have expected. So this is a narrative that we still constantly hear in the media every day. And it actually is not, it has not turned out to be true, at least last year. So how can we explain all this? Well, let's take a look at sectors, okay? So this chart, first and foremost, demonstrates that overall, the performance of US factors was driven by their representation in specific sectors, namely energy. So if you see the energy exposure, I mean, there's been broad representation across the sectors, if you see, but you see that in sectors like energy, to a certain extent, non-cyclical consumer and utilities, there were some, sort of outsized exposures, okay? Now, for example, we can look at momentum, and, it was largely driven by energy and financials, okay? But we still see, again, we see that most sectors exhibited positive exposure to momentum, right? So even though there's a sort of a broad exposure across sectors, we do see that there's an outsized exposure within some sectors, okay? And we see the similar story with the low investment factor as well. So that's one interesting fact here. Now, but if we move to performance drivers, then we kind of get to the heart of the story, okay? So as we all know, we all observe, the energy sector had a very strong year, okay? And it had, accordingly, a very strong impact on the performance of US long-short factors. So let's back up here for a second. Now, remember the old media sort of, what we see in the media sort of meme that it's just about profitability. Well, not necessarily the case. While it is true that many energy companies are highly profitable, there are many that are not, right? Or, profitable at all or highly profitable. But nevertheless, we saw that the entire energy sector did well last year. So it wasn't necessarily a profitability story as much as a sector story with energy in particular. Okay. So we see energy really, really making itself felt in value, momentum, and low investment. Now you also see how the narratives start to build, right? Because you had a good year for energy, and there was a value and energy were linked, right? So you also see how the story of, it was just a value story gets out. Even though we see that the numbers tell a different story, you see how the popular headlines were generated, right? So, long story short, there was a distinct sector flavor to factor performance in 2022. And it's important to keep that in mind as we go through 2023, because we want to keep tabs on each sector to see how is their performance continuing or differentiating itself from 2022. Now, we see in moving on to developed ex-US, we see a somewhat similar story in the sense that, half of the factors had positive performance in 2022. So it wasn't just a single factor story, although you do see, if we look at the table on the bottom, value and low investment in particular, were really shining examples of good performance in 2022. So again, you see why the value story had some legs, because both in the US and in the ex-US developed world, value did perform well. Again, that doesn't mean that it was only a value story by any means, but we see how that narrative came together. Now, value, low investment, momentum were the only factors that were positive. And so you see that low vol, size, and high profitability, again, counteracting that narrative that we heard, were also negative. And high profitability, again, was a negative outlier in that its performance was below its worst 5% annual rolling returns. Now, we're going to see here, again, we have a broad exposure to sectors, but if we go to performance here, we will see, once again, that energy had an outsized impact on factor performance in the developed world ex-US as well. So, the energy sector outperformed the broad cap-weighted developed ex-US benchmark by 32.4%. And again, it was a very important driver for value, momentum, and low investment. It had a negative impact on low broad volatility and high profitability. Interesting results. Okay, so let's recap for a second before we move on to our macro factors. What we saw was broad-based positive performance for the most part across our set of factors, except for high profitability. We saw that it was not just a value story. In other words, several of the factors performed quite well in 2022. Number one. Number two, we saw that it was really a sector-driven story, primarily driven by energy. And so now it's interesting to say, okay, we got the sector story somewhat told and complete. We understand that we had broad-based performance. But Joe, we heard that it was a big year for macro and a macro regime shift. Interest rates were going up. Well, what happened there was, did macro factors have any kind of outsized performance or unusual impact on the performance of factors? So we're going to look at that now. But before we do, let's describe what we're talking about when we mean when we're talking about a macro factor. So just like we do with our factor portfolios, we construct our macro factors using long-short portfolios. And what we're doing is we've got four factors here: short rate, right, which is proxied by 3-month T-bills. We got term spread, which is proxied by the 10-year minus the 1-year Treasury bonds. Credit spread, so you've got BAAs minus AAAs on the corporate side, and break-even inflation, which is a popular and well-known and commonly used measure of inflation expectations, which also has the advantage of being directly connected to the market in real time. So it's a very convenient measure, a way of getting the pulse of what investors in the market view as inflation on the horizon. So what we do here is we take a basket of stocks and we try to see the sensitivity of various stocks on each of our factors, but not only just the factors, but the sensitivity to macro surprises, right? So for all the econometricians out there, you would call these innovations. Okay, so we're not just looking at sort of the sort of standard performance, garden variety performance of each of these macro factors. We're just trying to see when there's sort of a surprise or a shock or an innovation, how does a given stock respond to that? And we take the stocks that have the highest sensitivity to those surprises, and we go long those, and then we short those that have the opposite sensitivity. Okay, and that's how we create these long-short macro portfolios. Now, here we show on this slide the performance explained by each of the factors. Now, again, for those who are statistically interested in how we did this, we simply took each of our factors and did a univariate regression on each of our factors. So in other words, we didn't look at a basket of our macro factors and regress them against each factor. We took each macro factor one by one. Okay. Now, let's go to the table here, and we see some very interesting results. So let's start with low volatility because it's one of the outliers. You see that quite a bit of its performance was driven by the macro factors, especially short rates. 46.7, almost 47% of its returns were driven by that factor. And term spread also had an outsized influence on this factor. But it's not alone. If you go just to the right, high profitability, you also see term spread and credit spreads and break-even inflation also having a very large impact on this factor. And if you go to the far right, you also see low investment have significant results. And then if we go to value, you also see a similar story. So, a couple interesting points here. One is that, a majority of the factors were significantly influenced by our macro factors. The second is that momentum really was not, right? So it was somewhat shielded, or if you will, from macro developments last year. Now, moving on to the next slide. So this slide is a continuation, really, but instead of looking at of the R squared or the performance explained by each macro factor, what we're looking at here is the beta or the coefficient, right? It's just the sensitivity of each factor to our macro factors. And again, it's data that is consistent with the previous slide in that low volatility, low investment, high profitability, and value really have higher betas, if you will, positive or negative, to the macro factors. And if you look at the short rate and low volatility, you see that's a very large influence that factor had on that macro factor had on on the low volatility factor. So, you know, interesting results for us as well, because, you know, like I said in the beginning, once you take a long-term view of the impact of macro factors on equity markets, you see that the results are not always very significant. Over the long term, they're not major drivers of equity factor performance. But this year or last year, you saw a somewhat different story. So, you know, whether or not that will change in 2023 has yet to be seen. But it was an interesting year in 2022 because you had this convergence really of interest rates normalizing, as well as energy really coming back as a performance driver. So with that, I will conclude my section. I'll hand it over to my esteemed colleague, Daniel, who will talk about the social distancing and intangibility characteristics of stocks and how they impacted factors in 2022. Daniel?
Yes, thank you, Joe. So Joe has analyzed the performance of factors through the lens of sectors and macro factors. I want to highlight or to show the impact of two important characteristics: intangibility and social distancing characteristics. So why these two characteristics? First, we believe that intangibility is a very important characteristic because the economy now is not anymore based on tangible assets as it was 50 years ago. Companies are investing a lot in immaterial or intangible assets. And if you look at the ratio, the share of tangible versus intangible assets of companies towards total assets, there is a rising trend over the last decades. And we are now in a, let's say, immaterial economy. So this immateriality matters. It matters for the economy, for the GDP growth. So we think it's an important characteristics to analyze. The second explanation or the reason, let's say, is that it's a hot topic in factor investing, especially for the value factor. Over the last few years, you have a lot of people saying that the book to market is not sufficient to capture this immateriality or these intangibles. And so you have two ways of dealing with that. Either you add different metrics, value metrics, or you do as what we do at Scientific Beta, you complement the book to market with unrecorded intangibles like organizational capital or knowledge capital to capture these intangible assets. And the last reason is that during the COVID, obviously, the shutdowns imposed by governments impacted a lot companies with high tangible assets. And you can make the link between these companies being affected because they could not run their activities anymore. So they had important impacts on their revenues and EBIT. So this is why we wanted to use this intangibility characteristic. For social distancing, the reason is simple. If you ask me 5 years ago, this characteristic would not have we would not have discussed this social distancing characteristic, but there was COVID. And in a previous IP article, we showed that this social distancing characteristics did drive a significant amount of the variability of factors during the COVID and afterwards. Because obviously companies that could not implement teleworking activities or could not use teleworkability were strongly penalized during the COVID. So how do we describe these two proxies? Intangibility is defined as the total intangible assets divided by total assets for each company. The total intangible asset is the sum of the recorded intangibles that you find in the financial statements and unrecorded intangible assets that we measure via knowledge capital and organizational capitals as defined in Amank and Al paper in 2020. And for social distancing, we use a teleworkability score that is defined in Cohen and Peto, which is measuring giving you the score for each company, and the score goes to 0 to 1, depending if the company is, let's say, capable to implement teleworkability in its activities. So a company which can use teleworkability for all its activities will have a score of 1, and we consider that as a strongly teleworkability company. So we do the same as for the macro analysis. We build long-short portfolios, which are based on these two metrics. So we go long for intangibility, we go long low intangible companies, and we go short high intangible companies. And similarly, for the social distancing, we go long companies with low teleworkability scores, and we go short companies with high teleworkability scores. And so we can do the same type of analysis. So we run univariate regressions. So we take, for instance, the value factor, the value performance of the factor. We regress this performance against the long-short portfolio for intangibility, and we get the R-squares and the betas. So the betas is the sensitivity of the value factor to, let's say, 1% performance of intangibility. It's the beta for regression. So it's what we call sensitivity. So when we look at the numbers on the US, it's very interesting because we see that the R-square, which measures the variability, the amount of variability that is explained by intangibility of social distancing, is very strong for some factors. So for instance, for value, you have 45% that is of the variability of the value performance that is explained by the intangibility long-short portfolio. And you have 28% for momentum, 41% for high profitability, 53% for low investments, which is more than half of the variability which is explained. So this is huge. And we've got the similar pattern for social distancing, but we see slightly slower magnitude of R-square for value and high profitability. Now, what is interesting to analyze is what is the sensitivity of these value momentum factors to intangibility and social long-short portfolios. So this is what you see in the second part of the table, the betas. And you see that value, momentum, low volatility, and low investment had positive betas, which means that these factors were positively impacted when low intangible stocks outperform high intangible stocks. Similarly, these 4 factors were positively impacted when the companies with the lowest teleworkability scores outperform companies with the highest teleworkability scores. So you see that high profitability, which underperformed strongly in 2022, had a negative exposure to both intangibility and social distancing characteristics. So this is an interesting analysis because it's a bit different from macro or sectors. It's taking into account very specific characteristics like intangibility and social distancing. And we see that these characteristics matter, at least on the US. Now the question is, can we do the same thing for developed ex-US? The answer is yes, which is not the case for the macro analysis that we've done only on the US. But for this, we can do on developed ex-US. And surprisingly, or not, I don't know, but the results are let's say, even stronger in terms of R-square. So the amount of variability explained by intangibility of social distancing is stronger than on the US, in particular for value, high profitability and low investments, where the R-square are above 50%, which is really strong. So this means that the returns of these factors were explained, the variability of the returns were explained by more than 50% by intangibility of social distancing characteristics. And the story is the same for the betas, so they go in the same direction as on the US. So there is the same kind of sensitivities than on the US. So to conclude this presentation on the review of equity factor performance in 22, I want to give you some few takeaways. The first takeaway is that factors are not dead. They are not dead because simply factors are a compensation for additional risks that can materialize in bad times. So you should expect some periods of underperformance or negative performance. This is why investors get compensated over the long term because they are exposed to additional risks. So in 22, the average performance of factors was positive across all regions, US, developed ex-US, global, universe, including emerging markets. So 7% on the US, 1.4% on developed ex-US, and 4.8% on the global universe. The second takeaway is that value was not the only good performer. As Joe mentioned, when you look at articles or news on the press, financial press, it's all about value, but the reality is that momentum did great and low volatility, low investment did great too. So this is a more broad performance of factors. The only exception is high profitability. After several years of positive performance, the factor had an exceptionally poor performance in 2022. This is consistent across all regions, US, developed ex-US, global. The performance was really poor in the sense that it was below the worst 5% one-year performance over a very long term. So we are using our long-term track record universe of more than 45 years to do this analysis. So this is the only exception on the let's say the bright side, the good picture of factors in 2022. And to conclude, the last takeaway is that long-short factors are not coupon-paying bonds. You should not expect to have every year a positive premium because the premium fluctuates through time. It might be impacted by sectors, and we've shown that the energy sector was very important in 22 and was a strong driver of the performance of factors. But this is also the case of the macro factors. And interestingly, the two characteristics that we discussed in the last 10 minutes, intangibility and social distancing, were also important drivers of performance.